We're seeing an increasingly important structural shift in the global monetary system, with the US dollar's share of global FX reserves falling to its lowest level this century, a development that should not be overlooked, particularly from a crypto perspective. At its core, this reflects global reserve managers actively diversifying away from the dollar amid geopolitical fragmentation, elevated US debt concerns, and a reassessment of concentration risk. This isn't a sudden loss of reserve status, but a steady erosion that creates space for credible alternatives. For crypto markets, and Bitcoin in particular, this dynamic strengthens the long term bull case. Designed as a non sovereign store of value, Bitcoin's appeal grows as trust in traditional frameworks is gradually diluted. Notably, it has held up well despite higher US yields and periods of dollar strength, suggesting markets are starting to price in this structural narrative. Bitcoin is also increasingly competing with gold. It offers a more efficient alternative in many respects: superior custody security when properly managed, provably fixed and scarcer supply dynamics, and far greater ease, speed, and cost efficiency in cross border transfers. With global portfolios still heavily tilted toward gold, even a modest reallocation could drive meaningful incremental demand. As institutional adoption deepens, Ethereum and broader digital assets are also well positioned to benefit from this diversification trend, particularly through their role in tokenization and the infrastructure of a more decentralized financial system. The bottom line: this gradual shift away from dollar concentration represents a powerful structural tailwind for crypto. It supports treating Bitcoin and digital assets as strategic, forward looking portfolio allocations rather than purely tactical trades in an evolving global monetary order. That's all for now.